Have you ever thought about trading ETFs? If you have, then you know that this is a very exciting and rewarding way to make money. ETF is a type of mutual fund that trades like a stock on the open market. However, it can also be a bit intimidating if you don't have any idea what to do. Luckily, there's a lot of information out there that can help you get started. Here we will look at the 5 best ETF trading strategies for beginners. Please like and share the video, subscribe to this channel, and click the bell icon for more updates. Number 1. Dollar cost averaging. We begin with the most basic strategy, dollar cost averaging. Dollar cost averaging is the technique of buying a set fixed dollar amount of an asset on a regular schedule, regardless of the changing cost of the asset. Beginner investors are typically young people who have been in the workforce for a year or two and have a stable income from which they are able to save a little each month. Such investors should take a few $100s every month and, instead of placing it into a low-interest saving account, invest it in an ETF or a group of ETFs. Advantages. There are 2 major advantages of periodic investing for beginners. The first is that it imparts discipline to the savings process. As many financial planners recommend, it makes eminent sense to pay yourself first, which is what you achieve by saving regularly. The second advantage is that by investing the same fixed dollar amount in an ETF every month, the basic premise of dollar cost averaging, you will accumulate more units when the ETF price is low, and fewer units when the ETF price is high, thus averaging out the cost of your holdings. Over time, this approach can pay off handsomely, as long as one sticks to the discipline. Number 2. Asset allocation. Asset allocation, which means allocating a portion of a portfolio to different asset categories such as stocks, bonds, commodities, and cash for the purposes of diversification, is a powerful investing tool. The low investment threshold for most ETFs makes it easy for a beginner to implement a basic asset allocation strategy, depending on their investment time horizon and risk tolerance. As an example, young investors might be 100% invested in equity ETFs when they are in their 20s because of their long investment time horizons and high risk tolerance. But as they get into their 30s and embark on major lifecycle changes such as starting a family and buying a house, they may shift to a less aggressive investment mix such as 60% in equities ETFs and 40% in bond ETFs. Number 3. Swing trading. Swing trades are trades that seek to take advantage of sizable swings in stocks or other instruments like currencies or commodities. They can take anywhere from a few days to a few weeks to work out, unlike day trades, which are seldom left open overnight. The attributes of ETFs that make them suitable for swing trading are their diversification and tight bid/ask spreads. In addition, because ETFs are available for many different investment classes and a wide range of sectors, a beginner can choose to trade an ETF that is based on a sector or asset class where they have some specific expertise or knowledge. A novice trader who closely tracks the commodity markets may prefer to trade one of the many commodity ETFs available, such as the Invesco DB Commodity Index Tracking Fund DBC. Because ETFs are typically baskets of stocks or other assets, they may not exhibit the same degree of upward price movement as a single stock in a bull market. By the same token, their diversification also makes them less susceptible than single stocks to a big downward move. This provides some protection against capital erosion, which is an important consideration for beginners. Number 4. Sector rotation. ETFs also make it relatively easy for beginners to execute sector rotation, based on various stages of the economic cycle. For example, assume an investor has been invested in the biotechnology sector through the iShares Nasdaq Biotechnology ETF IBB. An investor may wish to take profits in this ETF and rotate into a more defensive sector such as consumer staples via the Consumer Staples Select Sector SPDR Fund, XLP. Number 5. Short selling. Short selling, the sale of a borrowed security or financial instrument, is usually a pretty risky endeavor for most investors and not something most beginners should attempt. However, short selling through ETFs is preferable to shorting individual stocks because of the lower risk of a short squeeze, a trading scenario in which a security or commodity that has been heavily shorted spikes higher, as well as the significantly lower cost of borrowing. These risk mitigation considerations are important to a beginner. Short selling through ETFs also enables a trader to take advantage of a broad investment theme. Thus, an advanced beginner who is familiar with the risks of shorting and wants to initiate a short position in the emerging markets could do so through the iShares MSCI Emerging Markets ETF, EM. However, note that beginners stay away from double-leveraged or triple-leveraged inverse ETFs, which seek results equal to twice or thrice the inverse of the one-day price change in an index, because of the significantly higher degree of risk inherent in these ETFs. Please don't wait to ask in your comments section if you have any other queries. Thanks for watching. See you in the next video. Please like and share the video, subscribe to this channel, and click the bell icon for more updates.